Good afternoon, morning for some. Welcome to our LTCI Sales Bites discussion. This is Brittany Button, long-term care insurance specialist for Art Jetter and Company. Today we have Brent DeGroot, regional marketing director for One America, joining us. Now, as promised, we're going to keep these sessions short and simple for y'all today. So, with so many retirement portfolios becoming qualified, top-heavy, today we will show you a solution to use a portion of these funds to purchase a long-term care insurance plan. Also, at the end of this session, we'll want to answer any and all questions you may have regarding long-term care insurance, even if it may be off topic. Simply type in your questions in the chat box of this presentation and we'll address those at the end. So Brent, let's get started.
Wonderful. Thank you, Brittany. I appreciate the introduction there, and I want to thank everybody for coming out today as well. Appreciate your time and attention. And yes, as Brittany said, if we look at the retirement portfolios of Americans today, they are becoming very top-heavy with qualified dollars. So, putting off any tax payments until taking distributions from them. So if I would just kind of, again, look at American portfolios as a whole, doing some research here, I found that $2 trillion are held in non-qualified annuities in portfolios, 15 trillion in cash or cash equivalents, if you will, but 28 trillion in qualified fund vessels. And so as you can see, with these qualified funds becoming very top heavy, many advisors or insurance professionals didn't even know that you could use qualified funds to create a long-term care plan. So if you're talking to your clients about planning for long-term care, and hopefully you are, I would strongly suggest that you always plant the seed with every client and start that discussion process. Why not just reposition a portion of their qualified fund portfolio and create a great plan in place for those clients that could protect the whole portfolio. So that's really what we're going to be covering today. So without any further ado, let's just get into what we're talking about. So there's some advantages of using qualified monies with our solution. We call it asset care, and the funding solution, and I don't want to confuse you in any way, but the funding solution itself is called annuity funded whole life, because our asset care plan is a true whole life based policy. And I'll explain a little bit more why there's annuity in the naming of this fund source as well here in just a little bit. But a couple things that I really want to hit on, by using our solution here, the annuity funded whole life, or qualified solution as I'll call it. You didn't see my air quotes that I just did, but that's what that was, qualified. There's better leverage. We're going to give, right off the bat, a 20% increase to the amount that they transfer over to us. And I'll kind of outline that here in just a minute. Better cash value by bringing in those funds and giving it that bonus. Obviously, we're going to get a better cash value, better death benefit for those clients. And clients don't have to write a check each year. So many times clients get a little fearful of saying, gosh, do I really want to pay for this, for the rest of my life or until I go on claim? We've got waiver premium that are built into these solutions. So once a spouse or an individual would go on claim, that waiver would kick in if they're doing ongoing premiums. But many people like to just say, one and done. Let's get this thing over with. We'll put our plan in place and have that peace of mind needed. So those are some of your advantages there. So before I get into the whole solution as a whole, I like to go through the asset-based LTC concept. And really it boils down to two things. It's a base policy, life insurance or an annuity. So on our whole life side, it would be called asset care. On our annuity side, it would be called annuity care, really creative naming. I understand that. But so today, since we're focusing on our qualified solution, we're going to be focusing on our asset care solution, and that is a base life insurance policy. And you can see there's a number of ways to really fund these, but what I've got highlighted here is the qualified source. So you start with a base policy. Then you have the option to add a rider, which we call the continuation of benefits rider. and or COB, as you'll probably hear me refer to it. And I like to throw up the qualified money there. So both of those sources that are funding for this have been highlighted with the qualified money solution. The reason I like to show you this timeline is, again, we've got the base policy that creates a death benefit, and that's what they would use for any long-term care benefits up front. Now, if they would exhaust that death benefit, that's when the lighter blue portion of this timeline kicks in, our COB rider, continuation of benefits rider, and that can pay out for up to even unlimited or lifetime benefits. And usually when we do these concepts, that's exactly what we're building in. We're building in a base policy and a lifetime continuation of benefits rider. So that's kind of what that timeline represents. And I like to keep it as simple as that, because we've got a number of ways that we can create options and funding sources and that sort of thing, which can make this scenario a little bit more complex. But if I can keep it as simple as possible, base and rider, and that can cover them for life. So that's what this whole timeline really is all about. So what are the advantages of using qualified monies? Well, they've been saving in their retirement for many, many years. And obviously by saving that and having the access to qualified funds, if they needed a long-term care or had a long-term care event and needed the income for those expenditures, they've got qualified monies they can use, right? So that's the advantage. There is savings for that. But are there disadvantages as well? Certainly there are. Taxes come into play. These were, built or being used as a qualified source, so they're deferring tax payment until they take it out. So obviously, if they just had $150,000 that they were thinking about using, or had an event and they just wanted to tap into their portfolio and had $150,000 that they needed, by using the qualified funds as they were, just left in their portfolio and tap in only when they need them, taxes come into play. So I'm going to assume, somewhat of a higher tax rate. It was easier to just do a standard 25% reduction here, tax bracket, if you will. We could use 15, 20, it doesn't really, 22, it doesn't really matter, but I just wanted to show this for illustrative purposes, that the taxes would come off the top because they haven't paid the taxes on that. So any of the gain in those contracts are going to be taxed first, right? So last in, first out. So out of that $150,000, if they're in that 25% tax bracket, what's that removing? $37,500. So what do they really have available for them to out of that whole 150? Only $112,500. So, is that the best way to handle this? Just wait until they've got a solution and then tap into their qualified sources? I think not. There is a better way. And let's talk about that. And again, using asset care with the qualified fund source. So any qualified money that the client has out there, IRAs, 401ks, 403bs, again, any qualified source can be used. What we do is we will take a trustee to trustee transfer. So we'll take from whatever trustee or whatever account that those qualified funds are in, and we take that direct transfer, so no taxation to the clients here, and we put it into our qualified annuity here at One America. So that's where this annuity funded whole life kind of comes into play. We put it into a qualified annuity. We have to go from one qualified source to another. So that full $150,000 comes over, right? Well, the nice thing is we also give it a 20% bonus right off the bat. So that $150,000 now becomes $180,000 that they have to use for any qualified long-term care expenses. So that bonus really is a deferred fixed interest annuity with an income rider. So that bonus, really think of it as maybe an income rider, if you will. So again, from 150 now up to 180,000. So what we're going to do with that 180,000 is fund the base policy, that whole life contract that I had been talking about, over 10 years. So we split this $180,000 into 10 equal parts. So what we do over that 10 years time span is just fund that whole base policy. So we'll take out $18,000 annual distributions. Now, because we are using qualified funds, there is the taxation that does need to be realized. The government's always going to get their money. You know, if they saved it in a qualified vessel, there's going to be taxes that are due. But now we are splitting it out over 10 years versus taking it all at one time. So that $18,000 distribution goes to fund the whole life plan. So in year one, we take that distribution. What's left in that qualified annuity at OneAmerica? $162. Year two, we take another $18,000. Now it's down to $144. Year three, we just keep going down. You kind of get the picture here. So until the 10th year, now we've completely depleted the qualified source. All of those funds have funded their whole life policy. So what did that create? Well, in this particular example, I'm using a 61-year-old male and a 60-year-old female. So great way to look at this. But what did that create for them by creating this plan? And again, it's a one and done. They do a one-time transfer. We give it the bonus. Then the inner workings fund that policy over those 10 years. Just remember that annual distribution over those first 10 years will create a 1099 LTC. So if you're doing any tax planning with your clients and that sort of thing as well, keep that in mind. But what did that create? Over $63,000 per year per person of tax-free LTC benefits for the rest of their lives. Now, if they're both on claim at the same time, doesn't happen very often, but I like to still mention this. That could be up to $126,000 for both of them per year per person the rest of their lives. So let's wrap this up, kind of look at the big picture, if you will. So here's that $150,000 that we started with. If they left it where it was at and only pulled it out if they needed care, obviously they're going to pay some taxes, so they wouldn't get the full amount. Again, we can always adjust the tax rates there. We'd just adjust the numbers accordingly. Or we could use our annuity funded or qualified option here with Asset Care and do the transfer over to our qualified annuity at OneAmerica, give it that 20% bonus, and then fund over those 10 years. And that's what creates this great plan for these individuals. So hopefully this concept really rings well with you, or at least gives you something to think about. I really like to get the message out on this one because so many advisors and insurance professionals don't understand that qualified funds are an option when you're planning for long-term care. So if I looked at our quoting output, I like to show this here as well, just to kind of give you what the quoting output looks like. This happens to be page 3 of the quoting output. But what I really wanted to do is just walk through a couple things that you'll see when you do quotes like this. Now, remember, they only gave us $150,000. It's talking about the total initial premium here. And you're like, well, why is it $18,000? I'm not understanding that. Well, because we gave it the 20% bonus, and now we split that out over 10 years, that's where this initial premium of $18,000 comes from. So it's utilizing, it's just repositioning a portion of their portfolio to create this long-term care plan. What did this create for this 61 and 60-year-old female? A death benefit here of $176,246. That's what they're going to use first. So I like this page because it really kind of illustrates exactly what's happening here. So the face amount or the death benefit that's available in that whole life plan is what the funds that they're going to use first before they get into that continuation of benefits rider. So I like this. Again, if you look at the bar here, you know, the death benefit comes out to this point. If you look down to the timeline again, it matches up exactly with what that death benefit face amount is. So they use that first. If they exhaust that, that's when the continuation of benefits kicks in and continues on for as long as both of those clients can live. So what did that create here? Nearly $5,300 per month per person in long-term care expenditures. So any income needed for those expenditures, this plan creates nearly $5,300 per person per month. And again, if they're both on claim, that's over $10,500. Now, if they're both accessing that death benefit first, it'll eat up this face amount quicker. So just think of that, because we have acceleration options that we choose here when we're building these plans. Typically, we're going to do a 3% acceleration on most, but we can do a 2%, and I'll get into some of that here in just a minute. I'm going to show you a couple other quotes that I run before we started here today. But they're always going to use their face amount first. Once that's exhausted, that's when the continuation of benefits kicks in. So different ways of looking at this. So if I forward on here and look towards the bottom of the same page, it describes it even further. So it breaks out the premiums. So again, single pay annuity premium of $150, but remember, we gave it the bonus, so it's now $180, but their original premium that they gave us was $150. We then break out in that $18,000 amount that pays over 10 years. We break out both the life premium and the LTC premium. So what was used to fund the life premium? $94.42 out of that $18,000. Well, portion was used for the LTC premium, $85.59. Now, why is that important? Well, I like to point this out because our COB rider and the acceleration, that portion of these contracts is what is considered 7702B by the IRS. So there is options to be tax deductible, really depending on how they file. So if it's an individual, we're not seeing that much of that out there because the standard deduction is raised so high now. So we don't necessarily see this that often on an individual basis, unless they are getting to that, 60 to 70 age band or 70 plus age band. There we can start to see that even through the adjusted gross income calculations, that this portion of the premium, then some of that could be deductible to them. Now, if they've got a business and want to run it through the business, that's where we're seeing a lot more of these tax deductions being taken. So whether it's a pass-through entity, whether it's a straight up C Corp, there's still a couple options there to look at. But that's the reason why I wanted to break out and point out that we break the life and the LTC premium out separately. As I said, we used a 3% acceleration, which means we take that death benefit and accelerate it over a 33-month period. That's the 3% option. I didn't add any inflation to this, but again, you can see they've got $52.87 per person per month for the rest of their lives. Does have the waiver of premium. Everything is guaranteed. So guaranteed cash value, guaranteed premiums, all taken care of up front, so they always know exactly what they're going to get. So I wanted to show you that, but if you'll bear with me a minute, I wanted to do a couple things because I used, here we go. Hopefully you are seeing. As a matter of fact, I'm going to make sure you guys are now seeing this quote. Yes, you are. Excellent. I also wanted to show you what happens. Like I said, we did a 3% acceleration on that particular example, but here's the same: male 61, female 60. Instead of using a 3% option, I reduced it down to 2%. So what does that do? Anytime you reduce, it's going to increase the face amount that they have, but it's also going to pay it over a longer period of time. Instead of 33 months, the 2% option is a 50-month calculation. So we spread this $230,000 death benefit over 50 months. So there's an inverse relationship between that. By spreading that out bigger, even though it's a bigger death benefit, you'll see that their per person per month amount of LTC benefits is less, right? $46.15 here versus the $52.87 on the 3% option. Again, greater death benefit, but smaller LTC benefits. Again, what I did here was run no inflation on this. I do have an example where we can show inflation as well. But if I come over here, you'll see the difference then in the life premium and the long-term care premiums here as well. Now, let me just switch gears and let's look at adding some inflation. Again, I went back to the 3% option, so we're spreading it out over 33 months. So I left this at the 50-month payout, the 2% option, but I added inflation on the COB. So what did that $18,000 per year get us? It bought them a nearly $195,000 death benefit. So again, slightly less. Some of that premium had to go to the inflation. Once that death benefit would be exhausted, the continuation of benefits kicks in. But again, because we're adding now inflation, it further reduced the LTC portion. However, what we did, because we added the 3% inflation, that can increase as well. And so if you'll bear with me a minute, let me show you on our ledger pages exactly what happens. So they start out with an initial monthly benefit amount per person per month of $38.89. But because we're adding inflation on this particular example, I only did it on the COB. So they would get the same $38.89 until that death benefit's exhausted. But it's also increasing by 3% every year for a period of 20 years. So where is kind of the crossover point? Here around year 15 is what we're going to see, because now they would get up to $58.82. And then any years beyond that, it would continue to grow until it reached the 20th year of growth, up to $7,024 per month per person. So I wanted to just show you a couple of items there as well. So let me go back here to, wait till that pulls up. All right. Now, again, if we were looking at further examples of the original illustration that I said, $52.87 is their monthly benefit per person, but that never changes. We never added any inflation on this. But you can see each one of these $18,000 is coming out over 10 years to fund that whole life plan. Now, there is questions that I get around these ledger pages, and it typically is with this total death benefit, or the next screen that I'm going to show you here, the total cash value. So early on, because now we still have this qualified annuity that has funds, we also created the immediate death benefit of $176 that would be available to them. But now we're adding those two together. So even after the first few years, you can see that the total death benefit reduces until that annuity is fully funded, the whole life plan. And that's when we get down to this death benefit of $176,246. Now, if I move forward here, the total benefit amount, that's why it shows reductions here. It's because the annuity cash value is funding the whole life portion. So again, face amount is there right from the get-go, but that's why these total benefits will reduce until that annuity is fully depleted. So with that, I would like to open it up for any questions that would be around here.
All right. And Brent, we did get some questions, so we'll kind of tag team these. First and foremost, this was just a question regarding asset care in general. And I know Brent was showing a lot of the lifetime unlimited benefit periods. However, as it was asked, we can do limited benefit periods for asset care for individuals and those second to die joint policies. For many reasons, though, especially with couples, we do like showing the unlimited COB rider because the death benefit and the pool of long-term care being shared, by having the lifetime benefit period, we're guaranteeing both insureds to have long-term care benefits regardless who goes on claim first and spends through that death benefit or potentially limited COB. So we can design it 33-month AOB or your acceleration of death benefit and adding an additional 33 months as a COB, providing 66 months of coverage. Now, some couples will do that, but again, typically if you're asking, I know myself, and even if you go to One America for quotes, we're going to move forward with lifetime first and work from there. Next question.
I always feel, yeah,
go ahead.
Brittany, if I could just add a comment on top of that. And part of the reason is, if you're doing this long-term care planning, especially for couples, and you're adding that lifetime benefit, and again, as Brittany said, it doesn't matter who goes on claim first, how much they use, there's still going to be that unlimited COB for either person by adding that lifetime benefit. And I think that just truly gives peace of mind for your clients, and not only your clients, but really peace of mind for you as well. That way they're not coming back and invading the same portfolio that you have been helping them build over those years. So anyway, those are my comments. Thank you.
Perfect. Well, Brent, I'll let you tackle this next question. This one's actually more so on non-qualified funds. I've got a producer inquiring, what if they have a non-qualified annuity and want to use annuity-funded asset care? Is there also going to be that 1099 or taxation within those first 10 years with that type of plan design?
Yeah, great question. Typically with our annuity funded whole life, I don't like to use those non-qualified annuities. I would rather put that into one of our annuity care solutions and utilize a 1035 and really take advantage of the Pension Protection Act, because again, that's where we're going to get rid of all that taxable gain in those contracts by moving that over. And it's a simple, the only real investment from the client at that point is just moving it from one annuity to another. But now they've got the ability to get rid of all of that taxable gain if it is used for any long-term care expenditures. And that's all due to the Pension Protection Act. So typically what we will do is fund a solution like that to one of our annuity care solutions and take advantage of the PPA.
Correct. And, don't want to make it too confusing for you all, but yes, although the funds are going into that internal annuity within asset care, we are still taking a distribution from that to fund asset care. And so that's why we see kind of that tax event happen. Whereas, as Brent said, using annuity care, indexed annuity care, we can do straight 1035 exchange and have tax-free benefits for long-term care. Okay, we just got a couple more questions. We'll get wrapped up. This one, I'll try to keep it as simple as possible. For those of you who may be in the Washington State area or have clients in the Washington State area, you may be aware of their new Long-Term Care Act. Essentially, come 2022, citizens will be paying a payroll tax to fund a state long-term care type plan. It's pretty much $100 a day benefit, up to $36,500 in lifetime coverage, and they say they're going to have some inflation. We're still seeing a lot of vague language. To opt out of that payroll tax, there's telling us so far is people have to have private long-term care insurance, which is going to be read as insurance with 7702B riders. And so, yes, to answer your question, One America's asset care would qualify as an opt-out solution for those residents in the state of Washington. Brent, do you have anything kind of quickly to add there?
Yeah, quickly, yes, our solutions do fit there. I would say a couple things. I am hearing that some people are trying to just go buy the minimum amount of coverage so they don't have to deal with the payroll tax. Look, if what's good about Washington putting this in place or raising awareness is that it is forcing people to think about their long-term care plans. But if they're going to just pay the tax and not put a plan in place or just get the minimum, that may be not the right solution. So if they're already talking about it, just make sure that you present all their options so they just don't try and avoid the tax. That'd be my advice.
And Brent, I've been trying to keep a real close eye out on this because it's quite the buzz these days. Has Washington announced what the minimum benefit requirements are for the opt-out? I haven't seen anything, but I've been told it has to be at least $3,100 in monthly coverage, or it can be a bare minimum of whatever the insurance carrier allows. Have you heard anything specific?
I haven't heard the absolute specifics on that. I don't think that they've totally released it. I've heard a number of people say that it's got to at least match what the state of Washington is actually trying to put in place. But yeah, more to come on that.
Yep, and like I mentioned, we're all in the industry keeping a very close eye out on this. There's a lot of gray and vague language, so as we learn more, we'll definitely be getting that information out to you all. So one more question, and we're going to wrap things up for you all. Regarding, again, this annuity-funded asset care, we're showing with qualified funds, we can have joint insurance on there. Brent, producer wants to know, can you do that with a non-qualified annuity or cash value life insurance, one insured owns, and having joint insureds if they transfer it into asset care?
So we can do those types of plans or planning, if you will. Again, depending on which solution we're using, whether it's asset care or annuity care, if it's just a straight 1035, we've got to follow those rules where it's like for like. So if it's an individual, we may have to do individual plans. On the annuity care side, we can add the second spouse as an eligible individual, which is kind of nice because now we can partner both of them. The other thing that we're doing here as well is we can create a plan, even if they're taking their individual money, create two separate plans for both of them and just make the other the second insured. So it's they'd be receiving benefits from both policies, but they're both eligible to both pools. So lots of ways that we can access or use the funds that you've got out there. My biggest suggestion is just to bring those scenarios to Brittany and the team there at Art Jetter and Company. They know our solutions inside and out, and we can craft a great plan of care for your clients. So good questions. And before we wrap up, Brittany, can I make two pieces that I really wanted to also offer up under our qualified solution? RMDs. If your clients are not needing, once they reach the age of majority there and need to start taking RMD money, if they are not needing that for income, those 10-year payouts from the qualified annuity to fund the whole life plan can satisfy their RMDs. So that's a good little nugget that I wanted you all to have just in case they're not looking for that RMD to be used as income. And they want a way to kind of recognize that. Those distributions can be account towards those RMDs. So I'll mention that. And the second piece is, let's say it's an inherited IRA. Our annuity funded whole life solution, or the qualified option that we're talking about here, is really for 59 and a half and above. However, we also know that the great wealth transfer that is happening in America is passing wealth from one generation to the younger generation, to their kids. If they inherit an IRA or qualified source like that, so if it's an inherited IRA, they can put our qualified solution in place for them to create their plan using those inherited dollars, and that 10% penalty will not apply even if they're under age 59 and a half. So a couple things I just wanted to really kind of mention there as well on the solution.
Perfect. Well, thank you, Brett. And wow, thank you to this group. You all weren't shy, though we had a lot of great questions today. So again, thank you everyone for joining us. Also, thank you, Brent, for co-piloting today's session. But if you still have questions or would like a one-on-one discussion, please feel free to reach out to our team at 800-228-0008 or email us at ltci@jetter.com. So that'll wrap things up. I hope everyone enjoys the rest of their day. Thank you.
Thank you all.